The collapse of long-term capital management, LTCM, in 1998 was one of the most significant events in the history of modern finance. The hedge fund was founded in 1994 by a group of renowned academics and traders, including Nobel laureates in economics, and was intended to use complex mathematical models to generate high returns with minimal risk. However, the fund's strategy was flawed, and its collapse had far-reaching consequences for the global financial system. LTCM's strategy relied heavily on the use of leverage, or borrowing, to magnify returns. The fund invested in a range of financial instruments, including government bonds, currencies, and derivatives. Its models predicted that these investments would generate high returns while minimizing risk. However, the models failed to account for the possibility of large market fluctuations and correlations between different asset classes. When markets became volatile in 1998, LTCM's investments suffered significant losses, and the fund was unable to meet margin calls from its lenders. The collapse of LTCM had significant consequences for the financial system. The fund had large positions in a range of financial instruments, and its collapse threatened to create a domino effect throughout the financial system. Many banks and other financial institutions had lent money to LTCM, and their exposure to the fund's losses posed a systemic risk to the financial system. In response to the crisis, the Federal Reserve Bank of New York organized a bailout of LTCM, using a consortium of banks to inject capital into the fund and stabilize the financial system. The bailout was controversial, as it was seen by some as a bailout of Wall Street and the wealthy investors in the fund, rather than a rescue of the broader financial system. However, the alternative of allowing LTCM to fail was deemed too risky, given the potential for a wider financial collapse. The collapse of LTCM had a significant impact on the financial industry, leading to increased scrutiny of the use of leverage and complex financial instruments. The crisis highlighted the risks associated with financial innovation and the importance of understanding the limitations of financial models. The event also contributed to the development of risk management practices and increased government regulation of the financial industry. In conclusion, the collapse of long-term capital management in 1998 was a significant event that had far-reaching consequences for the global financial system. The fund's reliance on leverage and complex financial models, combined with its exposure to market fluctuations, led to significant losses and threatened the stability of the financial system. The response to the crisis highlighted the importance of risk management and government intervention in times of financial stress, and led to increased regulation and oversight of the financial industry.